Hello there. Welcome to Trading Day. I'm Andrew Bell. Let's get to the big stories we're bringing you from our newsroom. At a meeting of the Group of 7 finance ministers today, France's finance minister said the G7 group has not reached a deal yet on releasing oil stockpiles. This comes as the fighting in the Middle East drives crude prices sharply higher. A release from stockpiles could help ease supply disruptions that have pushed Brent, the world oil contract, close to $120 US a barrel. And Saudi Arabia has started reducing oil production amid the near blockage of the critical Strait of Hormuz, and that has started to fill up storage tanks. The cuts by the world's biggest oil exporter follow similar moves by the United Arab Emirates, Kuwait, and Iraq. Some countries have been turning production lower so as not to overwhelm storage too quickly and avoid a complete shutdown of output. We're watching shares in Constellation Software today. That stock slipping. The company's earnings were pushed down by a charge at one of its companies, which posted a large non-cash expense. The Canadian software giant posted quarterly sales of more than $3 billion, beating estimates, and that was driven in part by acquisitions and continued growth across its various software businesses. TSX down, but it is off the lows of the session. Of course, these oil prices have been tending to push energy producers higher. And let's have a look at the U.S. markets. They opened lower today, but they have recovered some of those losses. In fact, look at that. The Nasdaq now narrowly in positive territory. Still, investors have been shaken by this sharp rise in energy costs. So we have oil. We saw WTI today jumping above $100. Then it slipped back below that. Then it went above it again. But there's been a major rise in oil costs. And fertilizer supplies to the global market have also been disrupted. Large amounts of farm chemicals are produced in the Gulf region. Let's get more from Dec Malarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Dec, great to see you. Thanks for joining us.
Good to connect, Andrew. Great to be here.
Maybe we could put up an intraday or a one-week chart for the S&P 500. The market's shaken this morning, but they have come back a bit.
Yeah, there's no question. Yeah, there seemed to be a bit of dip buying. That wasn't necessarily the case last week, but it does seem like investors have reflected on what's going on over the weekend, kind of maybe put it in perspective and seem to be nibbling, certainly but just in specific sectors here. I think they're looking for value.
The market obviously trying to work out how long oil will stay in the $100 region. Maybe we can put up a one-week chart for WTI crude.
Yeah, that's the key question. I mean, what markets are dealing with right now is there's no obvious end game. There's a lot of, strategic ambiguity, let's say, around, where all this is heading. So I think markets at this point are looking for, okay, what's the bookend to this? And not seeing one, they're just pricing as they go. Mm-hmm. The $100 level we're at right now, that seems like it's a level that'll hang at here until it's clear. You mentioned in your intro there mm-hmm. about storage is getting pretty full. And if we get to that point, and which will start to happen in the next few weeks here, mm-hmm. you could now have an issue where, again, without any de-escalation, that oil could go to 120 to 140, which mm-hmm. would be a high when you look back historically. But we're kind of heading in that direction. Mm-hmm. We could get a spike like that.
It is interesting, though. Oil now only around 95. I mean, it's up, I know, about 5% today, but it has come off the highs of the session.
Yes, it has. It has backed up a little. I mean, some of it, I think, the suggestions about they could release some of the reserves that they have in the U.S. as part of it, separately are saying they could reach some of theirs. I think that's maybe helping markets a little. Mm-hmm. Like the one thing though, I would kind of add though as well is that the focus has been all on oil, but if you look at natural gas, which is so critical in terms of what comes out of the Gulf, out of Qatar for Europe and for Asia, that's completely its own story where you've got huge spikes there. And that's really also wearing on their markets quite a bit as well. So there's a lot going on here across the commodity complex. And you mentioned fertilizer. So it's kind of all hitting at once.
Yeah, of course, North American natural gas not really showing up yet because it takes time to increase export capacity, etc. Maybe, yeah, you mentioned fertilizer. Maybe we could put up NTR, Nutrien. On the face of it, these higher fertilizer prices good for that company.
There certainly are. But, the interesting thing with all of this hitting with higher fertilizer prices, we're heading into planting season for farmers. So this will be the issue if they stay at these levels. That gets more expensive. Clearly, that comes through the supply chain and starts to show up in food. So there's a lot of tricky elements here that are all coming together at the same time. So there's a lot of challenge. And that's where you see inflation expectations, inching up. That's reflected in, you look at yields across the globe. That's getting factored in right now is the expectation that, maybe we'll have more sticky inflation and stay higher, which, complicates a lot of things, including affordability, but also central banks' ability to cut. So we're dealing with a lot of those, that balancing act right now.
What about we've been talking about the Mag 7 endlessly for, it seems, years now. They've kind of gone off the radar a bit with this Iran fighting. What is your overall view, though, Dick? Are you picking away at those Mag 7 stocks, some of which are down this year?
They are down this year. It's interesting. They're still, this generate terrific earnings. As a bit of an aside, last week, the best performing sector in the S&P 500 was software. It had been maligned, and obviously it had been, in some respects, written off because of all of the damage that AI could do to it. And yet investors woke up and said, hey, there's still value here. So I think we're going through that kind of discovery where investors are saying, okay, how much of, who's going to make money on AI? Where is that going to come through? So that theme continues to percolate through markets. And I think that adjustment continues to get made, but these companies are still good. And that's why, holding a very balanced portfolio is the best approach, generally one of the best approaches in these types of environments, because it's just hard to know where the swings will go and ultimately where you land. But the one thing I will say is that investors, certainly in the U.S., are not materially repositioning away from equities. They are within it, but not materially away from equities.
What about gold, Dick? Are your clients or are your colleagues saying, hey, let's get some more bullion in here as a haven?
I think anyone. So it's a great question. Although gold and silver did not perform very well last week, and some of that, it could be just profit taking. I mean, you always have to put these in perspective. There's been such a run up, but I think you look across what most advisors are telling their clients entering this year was, okay, gold is a good diversifier, and same thing for the other precious metals. So I think that will continue, but there has been a leveling off in some of those levels, and I think that's healthy. So from here, it's hard to know where the gains are going to come from. But I do think companies in general, if we can get beyond this, will continue to turn out good earnings. So there's still a lot to like about equities.
Dick, thank you very much indeed. Dick Malarkey joining us there. Really appreciate it. Managing Director of Investment Strategy and Asset Allocation at SLC Management. When we come back, we'll check out today's trending trades. Let's check out some stocks on the move on a day where the market is being roiled by soaring oil prices. Nevertheless, they are down from their highs. Cameco is higher, not at a record high, but you can see up well over 150% in the past year. In theory, any disruption to oil supplies has people thinking about uranium as an alternative or at least a hedge. Of course, that's a thing that plays out over years. But Cameco shares up today. The chief operating officer saying last week that nuclear energy's future feels a lot more durable. That was the word from Grant Isaac, the president at Cameco. Nevertheless, we're not seeing a rush of new large-scale nuclear plant announcements in the West. We've got Shopify. It is trending marginally higher. That always helps the TSX. Canadian Natural Resources moving higher, and that stock actually hitting a record high today. No wonder with oil prices higher. Suncor coming along for the ride as well. Let me just check very quickly. It's interesting with Canadian Natural, it has gone well above the level of 2008 when oil briefly soared to $140 and more. And Suncor in record territory, down slightly from about a week ago. Some laggards on the TSX. The banks are suffering right now. And I'm not sure if that's partly just people moving money out of the big lenders and into the energy stocks. Anyway, Scotiabank actually cutting. Canaccord cutting Scotiabank shares to a hold. And we do know that if higher oil means higher interest rates, that's going to put more pressure on the bank's borrowers, and notably the mortgage holders. Let's have a look, or the borrowers, mortgage borrowers. Let's have a look at Brookfield, because that stock has been suffering as well. And in fact, those shares are down something like 14% this year. There are jitters about private equity out there. Brookfield, of course, a major player in alternative investing, and the stock down about 13%. There's a look at some stocks on the move. Xenon Pharmaceuticals, don't want to forget this one, making major progress with an epilepsy drug. Patients getting lots of relief there. Hims & Hers, do we have time to look at them? They are the drug seller, drug formulator. They have been a thorn in the side of Novo Nordisk over the past year. That stock taking off today because Novo has reached a settlement with them. Novo had previously saying that they were violating their intellectual property, but now Novo is going to market some drugs, some of the weight loss drugs through Hims & Hers. And finally, Live Nation reaching a settlement with antitrust cops in the United States. Investors happy to hear that, although antitrust busters have gone past, at Live Nation for years now without really curbing their operations. The massive boom in AI data centers faces a bottleneck. How do you persuade workers to move to some of the remotest locations in the US for weeks at a time? Enter the mobile housing companies trying to lure construction workers with trailers, stakes, and golf. Bloomberg's Joe Lovinger reports.
This story is about more than just AI. It's about the very expensive physical build-out that's required to power these systems. We've heard a lot about how it's difficult to find workers in construction already with the immigration dragnet that's happening. So in order to attract him to come work way out in the middle of West Texas, these man camp manufacturers need to offer things like golf simulators or fresh steaks to order.
To power the boom in data center building, companies are heading far outside of Silicon Valley, and cities in general.
We're starting to see some pushback from cities where residents are kind of concerned about what living near a data center might mean for their property values and for their way of life. We're seeing projects push out further into rural stretches of places like Texas and Louisiana because you can get much cheaper land out there, and you can also find municipalities that are more willing to work with you when you need to negotiate things like power arrangements or zoning changes. While the AI companies are duking it out to figure out whose model will win, there are these other companies that see opportunity just in the build out itself. There's a huge demand to build data centers as quickly as they can, so housing becomes a big bottleneck. Most of these places that these projects are getting built now just do not have the infrastructure that they need for this. Hotels fill right up, RV parks are completely full with workers. All of a sudden there's a line at the grocery store or at the gas pump. We have a lot of these sort of single lane county roads, and they're not built for rows and rows of heavy duty trucks driving on them all day. And so you get roads kind of deteriorating. People are paying thousands of dollars a month just to rent RV spaces near construction sites. We're seeing a wide range of companies get into this, all the way from wily locals that pitch together a little bit of land and sell the RV spots, all the way up to major publicly traded corporations helping house workers. They've helped with oil and gas and the shale boom. If you look at it from above, it looks like an Excel spreadsheet cut out of the middle of farmland. You get this paved surface where you have rows and rows of gray roofs and temporary housing. They'll have their own toilet or they'll have their own sink. They always have Wi-Fi so that you can make video calls to family back home. And then there will be a shared communal kind of dining setup. They place so much emphasis on the food, not only because these guys are working so hard all day that they need the calories, but also because it's an easy way to attract workers when there's such competition for them. We'll also see a lot of amenity space. These are workers that are spending 15, 16 hours a day doing manual labor. You know, I figured when they got home they'd want to go to sleep, but apparently they're often gyms so they can get workouts in.
Employment for construction workers is expected to grow 6% between 2024 and 2034, double the projected growth for all jobs, according to estimates from the Bureau of Labor Statistics. Roles for electricians, a particular bottleneck for AI construction, are expected to grow by 9% in that time.
There's a lot of hiring now that's happening from veterans because a lot of these jobs require you to be away from family in less than ideal conditions for weeks or even months at a time. The locals recognize these things contribute a lot to the property tax base. They'll donate to the local school district. They get very involved in the community. At the same time, these are people who chose to live in very rural stretches of the state, and so they're not used to having to wait in line to fill up their tank of gas or to get a sandwich at the cafe. And so there's a lot of frustration now with traffic, with certain quality of life changes that happen when you have a project of this scale in your town.
Locals also have some concern that these camps could become magnets for drug use or crime.
That is a concern among some locals in these towns because during the shale boom, when there were a lot of other temporary villages popping up, that could be an issue. Mayors are clear-eyed that these are short-term projects. While these data centers are being built out, at the end of the day, when these projects are done, these camps will mostly be taken apart. Some jobs will stick around, but the vast majority of them will go away.
Okay, fascinating though, the boom right now. It just must be wonderful selling electrical equipment in the United States. You're probably like, oh, we'll phone you back next month if anything comes in. All right, so we got that climb in oil today. WTI, the North American benchmark, about $95 right now. It is up 5%. Ride-hailing and delivery companies are feeling the pressure. Some of those stocks are seeing some selling. We'll be right back. Shares in Uber, DoorDash, Instacart, and Lyft have seen some selling today. They are exposed to oil shocks. Fuel is the biggest variable cost for drivers. Let's get more from Mandeep Singh, Global Head of Tech Research at Bloomberg Intelligence. Thanks very much indeed for joining us. So I mean, ultimately they might have to push up prices, and consumers would not love that.
Yeah, look, we've seen a similar episode back in 2022. When it comes to these services, there is certain demand elasticity that you see, when you raise prices and obviously the drivers have to bear the higher fuel costs, that reduces their earnings. And, these companies are able to charge a lower take rate. So from that perspective, higher oil prices are not good for this business model. With that being said, the ride-sharing element is probably more exposed to higher oil prices than probably the food delivery element.
No.
And partly because of the distances involved in, food delivery compared to ride-sharing. but there is no doubt that, this is the highest variable cost component. And so it will be a drag for all the gig economy companies.
And I'm trying to think, so for people taking Ubers or taking a shared Uber, I've tried that. I don't know if I'll rush to do it again. In any case, it could be bad for that, their business of providing rides.
Yeah, I mean, look, this is a very supply-driven model. So the more drivers you have on the platform, the better it is for ETAs. And look, there is always that threat of autonomous driving now with Waymo ramping up more supply. So in situations like this, you want these companies to be able to maintain that supply. And, for the drivers to stay on the platform, they want a certain level of earnings from, doing these rides. And once your costs go higher, and if it's not absorbed by these marketplace companies, which are asset light, mind you.
Yeah.
But at the same time, they still have to make sure that they are able to maintain their take rates while giving, their drivers their share in terms of the earnings expectations that the drivers have. So that's where when you raise the prices of oil, it does impact both sides.
Yeah. I see Lyft now pointing upwards. So it looks like investors are losing some of their misgivings over the oil threat because oil prices have come down from their tops of the day.
Yeah, I mean, look, there are other sides to it that, this could be a temporary shock. We're not talking about extreme scenarios here. And so this only plays out when you have this persist over time
Right.
and, oil price keep going higher from here.
We've only a minute left, but give us an idea. Waymo, the self-driving taxis, are they really going to be a thing in the next 2 years? For example, will a big section of the populace have access to them?
Yeah, I mean, Waymo has talked about expanding to 10 more cities in 2026. And so from that perspective, not only are they adding supply to existing cities they're operating in, they want to expand in newer cities. And there is no doubt that, the preference for Waymos is growing. And, the shocks like this oil price increase actually may favor Waymo more than the traditional ride sharing because at least you have mostly electric cars. And so from that perspective also, it could be a nice tailwind for their expansion.
Right. Apparently Waymo has lobbied or registered to lobby in Toronto, but our city is notoriously cautious about these things. So it'll be a while. Thanks very much, Mandeep. Really appreciate it.
Sure.
Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. Coming up, that virtual closing of the Strait of Hormuz, sending ripples across global oil markets. We'll have more after the break. The group of 7 finance ministers met today amid the surge in the price of oil. And the group said it will take any steps needed to support global energy supply, including releasing strategic oil reserves. However, apparently the gathering is not at the point of doing so yet. This news comes as the Middle East war drives oil prices sharply higher, and a release from global stockpiles could help ease the supply disruptions. Shares in Hims and Hers soaring. That U.S. drug maker has struck a deal with Novo Nordisk to start selling obesity drugs. This comes as somewhat of a surprise after Novo sued Hims in February for launching a copycat version of its new Wegovy weight loss pill, a linchpin of that Danish company's growth strategy. The drug maker accused Hims of breaching the U.S. patents on the ingredient behind its best-selling medications, Ozempic and Wegovy. With the closing of the Strait of Hormuz due to the conflict in the Middle East, the ongoing ripple effects are being felt in the markets. At one point, we saw oil surging above $100 US. Today, it has dropped a bit from that level. We're joined by Ed Yardeni, president of Yardeni Research. Ed, thanks very much for coming on the show.
Sure.
And I know it goes without saying, we just don't know how long-lived this spike in oil will be.
Correct.
What are your thoughts on that? Is there a risk it could be prolonged?
Well, unfortunately, there is my initial reaction on Saturday over a week ago, when I heard that during the first hour of the war, that Israel and the United States took out the top leadership of Iran, I thought that, well, maybe it'll be a short war. Then I kind of went back and studied what I'd known about Iran and looked into their paramilitary organization. It's part of the army, but it's actually independent of the army. And it's a terrorist organization. It was labeled as such. It's Islamic Revolution Guard Corp, IRGC. And they are the ones who have been funding terrorism throughout the Middle East, maybe in some ways around the world. And they're just not going to give up. Now that there's no head, they seem to be operating almost independently and just lobbying drones and missiles at even their neighbors, just creating havoc. The strategy of Iran now is just to create global chaos, and it's done a fairly effective job of that. And the assumption that they're working on is if they create enough chaos, the world will come back and demand some sort of ceasefire agreement between Iran and the U.S. and Israel. That's not very likely. So this war may take a while longer, simply because the U.S. and Israel are going to have to do something about the IRCG with their drones.
Yeah, I mean, it does seem to operate as a state within a state. It has extensive economic interests, etc. So it's not just a simple deal of, well, it never would be simple, but of dealing with the leadership as such in Tehran.
Well, as I said, it's a terrorist state within a terrorist state, and that's what makes them so dangerous. Is they're professional terrorists. This is what they do. They have a lot of power within Iran. They own a significant portion of the Iranian economy, and they're fanatical in their beliefs, which makes it pretty hard to just bomb them from the air and call it a day. Anyways, military historians have concluded a long time ago that it's very hard to win a war just from the air, just from air bombardment. Boots on the ground is really the only way to get an eventual victory.
But of course, that has quagmire written all over it. It sounds like something Mr. Trump would be very reluctant to approve.
That's right. So it just could be a continuation of this kind of warfare. And maybe along the way, both sides will conclude that they need at least some sort of temporary ceasefire. The key, of course, is the Strait of Hormuz. It's effectively blocked. The insurance companies won't insure vessels. The United States said they'll insure up to $20 billion, but that's kind of a drop in the Persian Gulf, really, in terms of the kind of money that the owners of the vessels would want. And in any event, even if they're well insured, it's not clear that they're going to want to see their vessels targets of suicide drones.
Yeah, I mean, the danger to life and limb, among other things. You yourself have said that there is a risk of a pretty serious sell-off in U.S. stocks this year. Can you just give us your thinking on that, please?
Yeah, well, Tuesday, a week ago, when I had my second thoughts about a quick war, I suggested that we could have a 10 to 15% correction in the S&P 500. Now, I think it's important to realize that there are differences between what's going on now and what happened during the stagflationary 1970s. Back then, we had two oil shocks. They caused two recessions, but the U.S. economy was a net importer of oil. It was much more energy intensive. The U.S. is much less dependent on foreign oil. As a matter of fact, we are a net exporter of both oil and gas. So the impact isn't likely to include a shortage of natural gas and oil. It's just the price is going to be elevated. And the problem with higher prices, it could certainly, with higher gasoline prices, depress lower income consumers. And if the stock market remains depressed, it could feed on depressing higher income consumers who have been making a lot of money in the stock market.
Because the U.S. economy is, according to some accounts, pretty energy intensive compared to other developed countries. So there is a vulnerability there.
Well, I'm not so sure about that. The energy agency that collects data at the Energy Department, they have a chart showing energy intensity, and it's down significantly in the United States over the past couple of decades. So our companies aren't net. Again, we've had a lot of movement away from manufacturing to services, which tends to be less energy intensive. Also, the movement to digital in the past was less energy intensive, but now with AI, suddenly we're going to become a lot more energy intensive, and that's why we're building more electricity generating facilities to accommodate all that. But yeah, this is it's a bit of a shock for everybody for sure, and you know, it's hard to see that anything changes in the next few weeks. With the administration saying it could take a few more weeks, and the risk is it could take longer than that.
That's interesting. Yeah, I'm just checking the actual energy. The economic weight of energy has actually dropped in the US, and apparently that process really got going in the 1970s.
Correct.
We'd better jump. Ed, thank you very much indeed.
Thank you.
Ed Yardeni, president of Yardeni Research. When we come back, Live Nation reaching a settlement with federal antitrust authorities. We'll hear from Bloomberg's Josh Sisko after the break. Live Nation Entertainment and its Ticketmaster subsidiary have reached a settlement with federal antitrust authorities. This has thrown a wrench mid-trial into that antitrust case that had accused the company of illegally monopolizing live music. Let's get more on what we know and we don't know. We're joined by Bloomberg's Josh Sisko. Josh, thanks very much indeed. Can you just remind us,
thanks so much for having me.
Before we get going, what was the essential complaint of the antitrust regulators?
So at a high level, the Justice Department and several dozen state attorneys general in the U.S. said that Live Nation has illegally monopolized much of the live music of the concert industry in the U.S.
Right. And what do we know about the settlement here? How did they reach a deal?
So they've been furiously negotiating over the past week or so since the trial started in March. And the two sort of key things address the two major complaints in the lawsuit, which is Ticketmaster's exclusive agreements with venues to be the only ticketing company, and as well as the company keeping rival promoters out of the venues that it owns and controls. So now, under the settlement, competing ticketing companies like AEG's Access or SeatGeek will be able to sell some portion of tickets to concerts that are run by Ticketmaster, and also rival promoters will be able to put on shows in most of Live Nation's large venues.
Is there any sense in which this will diminish the power of the company, or too early to say, I imagine?
It's a little too early to say, and it's so early that there's conflicting statements about what exactly the settlement entails. This was just disclosed formally this morning in New York federal court after we reported it last night, and it's a little, there still seems to be some details that are in flux, and I think more will be revealed. But the DOJ is maintaining that this will, in fact, lower ticket prices if you have competing ticketers that are allowed to sell tickets to the same concerts.
It's interesting. I'm such a cynic. I'm thinking concert ticket prices won't come down that much, but maybe I'm just old and bitter.
Well, I mean, it's unclear. They are very high, and that is like the main consumer kind of fan complaint about the company. And the lawsuit didn't specifically set out with a claim that says Ticketmaster's prices are illegally high, but hopefully the end result will be that stuff is cheaper for kind of the average consumer.
Thank you very much indeed. A fascinating story. I really appreciate it, Josh.
Sure thing.
Bloomberg's Josh Sisko. Coming up, Hot Picks, we zeroed in on 3 plays in autos. We'll be right back. On the Hot Picks today, we talked to one of our favorites, Tom Narayan, a lead equity analyst for global autos at RBC at Capital Markets. So we looked at three ideas in auto stocks. We started off with a Swedish supplier of a big chunk of the world's airbags. Let's have a listen.
I think it's a majority owned by U.S. investors. So they make airbags. And they are the dominant player in airbags. They have over 50% of the market.
Wow.
You don't have to worry about EVs or anything like that. Cars need airbags. Just a really cool mousetrap type company. We really think it's a special company.
That's interesting. I mean, I guess there's a moat, isn't there? There's huge safety regulations, et cetera. Hard to break into it, that market.
That's right. They have this strong moat. It's like the overall addressable market for airbags, surprisingly, isn't super big, but that creates an advantage, right? So if you're an automaker, you're not going to try to get into that business. You'll just leave it to Autoleave. And if you get the airbag wrong, I mean, it could be a disaster for you. So automakers are like, you know what, we'll just use these guys. We're not going to do this ourselves. And the number two guy that does airbags is way smaller. They're not as good. They're not as automated in terms of their production. They're actually trying to sell that business. So it's a really cool moat, like you said.
Your next idea, GM. Why do you think this is a promising one among the automakers?
Sure. I mean, automakers right now, it's a tough place to be. You're worried about the Chinese coming in, and even in China, there's competition. Europe is, there's a lot going on there. And so the cool thing with GM is it's really self-contained in China. That's not a big place for it to be. It is not in Europe at all. So you don't have to worry about the Chinese competition into Europe. And then in the US, it's like 60-70% of large SUVs. It's buying back a lot of stock. It has run quite a bit, but then the pullback now, thanks to the geopolitical situation, I think creates a unique opportunity.
I'm sorry, but they must be in Europe in some sense. They're just not in EVs. They're not in Europe?
No, they're not. They're not in Europe at all. GM pulled out of Europe. They used to be with, Opel and Vauxhall. They used to be a player there. But a couple of years ago, they pulled out completely, which probably been the wise decision thanks to all the competition happening there.
That's amazing. Because they had Opel for years, I think you mentioned. That was a great brand. And so they just abandoned the European market. And they couldn't even make SUVs or crossovers work in that market.
Right. Yeah, I think they saw the kind of what was going to happen in Europe with the, the competition there. Also, the CO2 rules are really stringent and strict there. So I think GM realized, let's stick to our core knitting, this like ICE, large SUV in the U.S., which is protected, right? Like, I don't think the Chinese are going to come to the U.S. for a while. So I think they really saw the future and acted on it. And it looks like it was the smart decision.
And what are they doing now in electric cars? Can you remind us, or do they have a big investment program still in EVs in North America?
Sure. They were kind of later versus what like Ford did, for example, and that kind of helped them out. I think, Ford went aggressively with like the Lightning and the Mach-E, and there was a lot of competition. And now what we're seeing with all the policy shift in the U.S., that's hurting companies that really went aggressively EV. What GM did instead is do a flexible architecture. So on the same production line, they're making an ICE car, like a non-EV. They can also make an EV. And so what does that mean? Let's say EVs aren't in favor. They could just make more of the other types of cars. Whereas other companies, they have a plant that only makes EVs, and those are, facing some hard times. So they do make EVs, but they were kind of smart about it so they could pivot towards ICEs. You saw a lot of these impairment charges that the Detroit 3 took. GM by far was the smallest that they had to take because of how they engineered their manufacturing.
And so they have the Chevy Bolt with a B, and it's apparently rare. It's less than $30K in the U.S. market. Rare to get one below that price point.
Yeah, I mean, they also have the Equinox and the Blazer EVs, but they've really been deprioritizing that EV push right now for obvious reasons. And what they really want to do is really stick to their core knitting, right? Large SUVs, pickup trucks, the ICE business, and I think they're also going to benefit from the tariff change that probably is going to happen. They produce a lot in Mexico. So I do think a deal that the administration strikes there could be another advantage. And, if you're the administration right now, you probably want to strike a deal given everything that's been happening.
And then finally, something a bit racier, Ferrari. What's the attraction there?
Yeah, look, this stock has been, a monster success for years. And a lot of people, the biggest pushback we always get is, oh, wow, this thing is so expensive. And it has been, but it's pulled back a lot, right? Thanks to some of the geopolitical stuff going on. Also, they had an investor event in October last year where they tried to manage expectations lower. And the market really didn't like that. The stock really pulled back like 30%. So we think there's a cool buying opportunity here, a rare one. This stock rarely, pulls back a lot. It's just a great business. We all know what it is. I think that's a growth story. The ultra high net worth category is one that is growing. It's pretty economically resistant. What's happening at the lower end of the economy is it's really untouched for Ferrari, and they have a new car that's already selling today called the F80, which is a €3.5 million priced car. Super high profit margins. We think they're doing 800 of these over 3 years. When you run the math on that, it's hard to not like what you see. I think that the company is just trying to manage expectations. And like we've seen historically for this company, they always, to use an investor phrase, beat and raise, and I do think you're going to see more of that from Ferrari.
The F80. I guess if there was prolonged disruption in the Middle East, Ferrari and other deluxe car makers would feel some pain.
That is true. In the past, they did see there was oil shock in the Middle East. They did see a little pain on residual values, the secondary market, which does impact Ferrari. It's something we're definitely closely monitoring. I think the Middle East is about 10% of their car sales, though, so it's not the end of the world, but the residual values could trickle down overall. So something to monitor for sure. Hopefully, obviously, this is a short-lived geopolitical situation. If it's long-lived, then I think Ferrari would also be a company that would be impacted.
Okay, a Ferrari. I asked somebody I know owned a luxury car. I said, do people mess with it, like bump into it for fun? He said the problem was people climbing on it so that others could take their pictures sitting on the hood of the car. Anyway, let's have a look at the markets before we go, and we'll check in on, the stocks not down as much as they were at the open. Another look at oil, because as I pointed out, oil is up today, but at the top of the show was up about 4 or 5%. It's now below $95. So the spike has eased off a bit, but certainly consumers around the world looking at higher prices. It's interesting. I was reading an op-ed in the New York Times today by Rosemary Kalanick of Defense Priorities, which advocates for a strong U.S. military but less involvement abroad. She argues that the U.S. is still an oil-intensive economy, about, 40% more oil-intensive than China. And Europe, she argues, is only half as oil-intensive as America. But Ed Yardeni pointing out that oil intensity has dropped. But of course, America is vulnerable in that sense, even though it has big oil exports to higher oil prices. Let's have a look at the Canadian banks, because they are suffering today. And not so long ago, the banks index was hitting record highs, but we have seen a sell-off today in CIBC and also in Bank of Nova Scotia. Because, of course, if oil prices stay high and gasoline prices, if they, heaven forbid, move towards $2 a litre, that ain't good for consumers and consumer lending. Thank you very much indeed for watching our show. Remember, Know Your Options is back on